Welcome
getting the
back, everyone, to Wall Street Beats as we are winding up 2024, specifically today, December 23, 2024. Get your trades in because I believe the New York Stock Exchange tomorrow is only open until 1 o'clock Eastern Time. I'm your moderator for this session. I'm Paul Meeks, one of our tech voices. I have some esteemed colleagues, guys I love to be with, get a lot of good ideas from. We have Benjamin Bry, Charlie Peabody, and Kevin Bakes Baker. So today we're going to start with Ben. What say you, sir?
All right, Christmas Eve. It's good to see you, boys. Two things. One thing on the morning show, Nadine and I had the algorithm pop up. Short Palantir. We shorted at 80.64. It's already down a couple bucks. Last week we had shorted Tesla. Kind of similar concept. These stocks just got way over their skis, and like the whole Silicon Valley's running the country and Elon Musk and whatever. Doesn't matter. These things they're fades. Last week Tesla went down 13-14%. That was good. I think Palantir at 150 times earnings. Great business, smart people, nothing against the company. Just I could see 10% come out of this thing pretty quick. So they got that. But then on what I wanted to talk about more.
Ben, before you do that, just let me ask you. I don't want you to unveil your secret sauce, of course. People should pay you for that. But what is the driver of your algo? Just give me like the basics. How would Palantir show up on your screen? Just simply because it's overbought?
Yeah, if you think about any time series or a stochastic process, there's like a random error to these things, and then so once you go and you see a chart basically get way like a z-score, a deviation from a trend, it gets what the mistake I took a long time to make is you don't want to do it too early. You gotta let it get a little bit more, and you wait. So when you want to short it the first time, usually you put a post-it on your screen and says, come back to this in a week, and then or 2 weeks. And so you're sitting there waiting. And then also the algorithm kind of popped it up on a more shorter term. But we had the stats were like, hey, we should make 6 to 10% based on a 1 to 10 day trading period, and risk reward is about 3 to 4. Expected return of probably 400 to 500 basis points. And look, it's already down $3 since we shorted it this morning. That's a pretty decent move. What?
So, Bill, I just wanted to ask you about that. You and I have never had that conversation, but what do you got for us today?
Yeah, and just to finish that is that my strategy and how I operate is very much driven by asymmetry. So where I can find asymmetric positions. So I'm obviously on the long side. I'm the guy who's told you guys to buy Chinese stocks last January, which we're digging in the dirt there. And just some Match.com, a British Tobacco in May, like stuff that other people don't want. And because you have the asymmetry, you have the upside is much better. Now, obviously, longs are better than shorts because you have the positive convexity. But in shorts, it's the same thing. When MicroStrategy, Tesla, anything, once you have all these buyers, now that's latent capacity or latent like selling pressure that can come. So if the price like momentum starts to decay, everyone who just made a bunch of money running up the stock, those guys can be selling now. And then more importantly, there's not a whole lot of bid when it goes the other side. So you can get these like quick 10 to 20% moves, and you don't have nearly as much like on the upside. It's like everybody wanted to buy is pretty much bought. So it doesn't mean it can't go up, but once you see the energy run out of these things and you start to see the momentum decay, I tend towards those shorts for trades. Nothing to do with, the fundamentals of what they're going to earn or anything, but just like more trading oriented. Okay, so on what I wanted to talk about otherwise was Charlie and I have gone back and forth a little bit, but let's rewind to September this year. And Charlie and I were on the show, and I said it was time to short bonds right the day before the Fed meeting, short bonds. And that's been pretty good. The SFR Z5 is down 125 basis points for the short end. So just so you guys don't know, that's the policy rate futures. It's a secured overnight funding rate. And it's trades on a 0 to 100. So you do 100 minus the price, and that's your implied break-even rate. Right now it's at 96, implying 4% break-even by the end of by 25, and so a year from now. And there's a little bit of term spread, like maybe 8 to 10 basis points. So they're implying a little less than a cut, basically, 70% chance of one more cut. And that seems ridiculous to me. When it had 5 cuts back in September, that seemed aggressive. Now you're not paying for much at all. You're getting you have to pay for a little bit less than a cut. I could see rates at 2% by next Christmas. And you know what? Back to the asymmetry I just talked about. I don't see rates higher. So yeah, worst case, you sit there and it's dead money. And best case, things get ugly and the rates are at 2%. And we all know they take the elevator down with rates when things get ugly. So you have a fantastic asymmetry to this bet. And just so you guys know, it's like about $800 to $900 initial margin per contract, $2,500 per 100 basis points. You could put on 40 grand, and that's a DV01 of 1,000 basis points. That would be, if you had the futures account, you could make some pretty sizable cash. If you've got 100 basis points, you make 100 grand on 40 grand of initial margin. So 2.5 times your money. It's negatively correlated to all your other assets, and it's very asymmetric, in my opinion.
It sounds like a good idea. Thank you. Charlie, let's move on to you. You have a myriad of macro variables and some micro stuff, including consumer confidence. It just came across the wire. What do you think of today?
Yeah, so why don't I just start with the consumer confidence? And as you said, it just came across the wire, so I haven't had a chance to read the full release. But consumer confidence came in below expectations. The index came in at 104.7. Expectations were for 113. Most of the miss and the drop, because it was down 8 points from last month, was related to future expectations as opposed to current expectations. And when that gap between current expectations and future expectations widens out, as it has been, it's usually signs of a pending recession. The future expectation index came in at 81.1. Below 80 is usually associated with a recession. So I'm going to stick to my belief that, and I was very adamant last year that we were not going to have a recession, but I'm going to stick to my belief that a recession in 2025 is still a possibility. But what was interesting,
that would be a blow to the consensus if that unfolds.
Yes. Yeah. It is interesting that when you look at some of the subcomponents, the expectations of buying a home continue to deteriorate. And so I'm going to use, there's more in this release that I haven't had a chance to review, but I'm going to use that as a lead in to talking a little bit about Winnebago. As since last August, I've had this theme that anything that needed to be financed was going to disappoint. And by things, I've talked about homes, cars, boats, RVs, motorcycles like Harley Davidson. So Winnebago reported, the motorhome company, reported earnings on Friday before the opening. So the market's already reacted to them. The stock was down 4% on Friday. It does show that the theme continues to play out in a disappointing fashion. They missed on both revenues and earnings. Their revenues were down 18% year over year, largely driven by disappointing motorhome and tow home sales. I think there was about a 7-point percentage differential between expectations and what they reported. And they disappointed on earnings. They lost 18 cents a share in earnings. Again, for the reasons that I've been highlighting, they are facing competitive pressures on their margins for discounting to move product off the lot. There is a positive note. Their marine division actually did well. That's Chris Craft is their marine division. It actually did fairly well. And that may have some implications for Polaris and Brunswick, two other names that I've been short on the marine side, on the boat side. But on the motorhome side, Winnebago continued to lose market share. Some of their dealers are facing financial pinch and therefore not taking the product. They did, in terms of forward-looking guidance, they did say that the second quarter was probably going to be not too much different than the first quarter in terms of sales, although they expected profitability to improve in the second quarter. And they reiterated their full-year guidance, which I was surprised by, with revenues in the $2.9 billion to $3.2 billion range, and earnings at 375 as the midpoint between a very wide spread between 310 and 440, 310 on the low side and 440 on the upside. So I'm not sure if they're going to lose money or break even in the second quarter. This forecast of earning 375 a share in fiscal year 25 is very back-end loaded. And I suspect there's an assumption that the economy is going to continue to improve and that rates are going to go lower. And I certainly don't share those biases. I'll leave that there, and we can come back and talk about some other things if you want.
But before you move on, so it looks like even though the stock got hammered on Friday, right? So it's now in the stock price. You think the fact that they are sticking with their guidance is unrealistic and probably could still
I
short
do.
it. Okay.
Yeah. Can you get bounces along the way? But there's no catalyst. If the second quarter is going to be no better than the first quarter, there's no catalyst in the short term that I can come up with other than a macro catalyst.
Right.
Let's say rates drop back down to 3%. Let's say Ben's right, which we all doubt Ben's going to be right. But
Dang,
right before Christmas, it's supposed to be friendly. Did you have anything else, Charlie?
yeah, there are a couple of things I want to point out. We have literally just had the highest quarterly rise in interest rates across the yield curve. Rates have risen, as Ben pointed out, 60 to 80 basis points across the yield curve here in the fourth quarter from the September closing levels. That is the highest rate of increase that we've had in rates in a single quarter since the second quarter of 22. And you may not remember, but it was in the second quarter of 22 that the third quarter of 22, it was in the third quarter of 22 that the marketplace finally realized that Powell was not going to stop in his raising of rates, and markets sold off quite violently in the interest rate complex. So we're seeing a lot of, to Ben's credit, we're seeing a lot of discounting of the possibility of a hawkish environment on the rate side in the fourth quarter here. The reason I bring that up is because the regional banks, which peaked, if you look at the KRE, the regional bank index peaked on November 25th. And I pointed out a couple of weeks ago that it was one of the highest weekly RSI overbought readings in a decade or so. And therefore, some sort of backing and filling or consolidation was likely to take place. And sure enough, what we're starting to see is concern about this backup in interest rates on the fundamentals of the regional banks. And the one area that I don't believe has gotten a lot of press or focus is what these regional banks are doing with interest rate swap hedges. And I think this is very important because many of these regional banks about a year ago were putting on what we call forward starting swap to hedge against lower rates. And if you think about it, a year ago, we were thinking that we were going to have multiple cuts, 4, 6, 8 cuts in interest rates. And if we don't get those cuts in interest rates, we're going to see some significant losses in these swap books. And those losses have to be recognized in their capital account and then accreted back into earnings as a contra account to net interest income. I apologize if I'm getting too technical here, but it will act as a drag on revenues in ensuing quarters. And I did a piece over the weekend, which I'll publish later today or tomorrow morning on Wall Street Beats, showing that drag for a number of banks. And PNC and Citizens Financial, CFG, show up as having significant drags over the next 12 months from these interest rate swaps. So I'll leave that there.
Okay, well, thank you.
Actually, one last thing, because we do have new home sales tomorrow. That's an important number because if that number is weak, as it was last month, I mean, we came in at 610 last month. Usually we run 700,000 units over a month. If that comes in weak, that does not bode well for the economy because home starts have a multiplier effect in terms of construction jobs. And usually that's where you start to see recessionary signs when construction jobs are eliminated. So if we don't get a pickup in home starts or new home sales, and we already have existing home sales and mortgage applications at 30-year lows, if we don't get a pickup in new home sales and starts, that doesn't bode well for the economy either. Sorry.
Yeah, and just to add to that about the domestic economy is, let's just remember it's a global economy and the rest of the world is just crumbling, just terrible. So the natural rate of interest is much lower on a global scale. China, I don't know if you guys seen China's bond market, but holy cow, that is just a ripping bond market. Like those rates are just falling like an anchor to the bottom of the sea. And that's the global production. That's the second largest economy. Europe is a disaster. Japan is meh. So we'll follow them because the longer they try and play this game, tough guy game, the dollar's at 107, 108, we'll be at 110, 112, and people will realize that the dollar will just wreck things. And it's just a matter of time till rates are lower and everyone can accept reality. And Charlie's recession. Maybe we get some Doge and some cutting of the deficit. That's negative for S&P earnings, negative for the economy. 2025 is going to be a rough year, boys. It's good 2020. Strap in for next year.
I saw the consensus estimate for non-GAAP EPS growth for the S&P is 15% in 25. Very
You know what?
aggressive.
Actually, one thing that's not talked about enough, GAAP, so generally accepted accounting
Yeah.
principles, which we all agree on, earnings for the S&P 500 are $202, and they've been $200 for 2.5 years. There's been no earnings growth in the S&P for 2.5 years, but the stock market has gone from 3,400 to 6,100, all multiple expansion. So if they don't get those earnings, that multiple might have to compress a bit.
Hey,
Also
Pete,
on those
move on to
earnings.
you. Oh, sorry, Charlie. Did I cut
No,
you
just,
off?
just another add on those S&P earnings. I think somebody put out a chart saying that S&P earnings adjusted were 250 for this year. The numbers I see are like 240 and 275 next year. But the numbers that this chart had was 250 this year. But if you took out buybacks, which I believe are a record level this year, it would drop to 211. And I can tell you from my industry, buybacks have been very robust this year, partly because the expectation that deregulation is going to roll back some of the capital requirements, and partly because the credit cycle has not turned out to be very bad at all. So if both of those things reverse, if capital gets impaired because of higher interest rates from these interest rate swaps that I was talking about, or a credit cycle develops, you're going to see buybacks turn off very quickly. And that's going to change the dynamics for S&P earnings.
Those earnings are a joke, though. Ed Yardini has a site with a lot of free charts where you can see, okay, so I'm a sell side analyst. I come out with a 2-year forward earnings. And what do? They just steadily come down. You know what I mean? Wall Street sells these inflated earnings, then they revise them down, and they're like, they beat earnings. The whole thing's a joke. Like, their earnings haven't grown in 2.5 years outside of the very top stocks, and that's why the very top stocks have dominated, because they've actually grown earnings. You know what I mean?
Right.
No one else has done anything. That's it. I mean, there's a reason why the Fantastic 15 has kicked ass, for lack of a better word.
Yeah. Hey, Bakes, let's move to you for some technical analysis. I'm going to set the stage. I think you're going to lean into Eli Lilly today, which is the number one stock, 12% weighting in healthcare in the S&P 500. Stocks up over 30% on this GLP-1 stuff, and I think the sector is flat on the year. So it's obviously a kick ass, as Ben would like to say. What do you got?
And this is what I do for all our subscribers. Every time we talk about a stock, I put it into my system and I look at it every single day. And my eyes catch things after all these years. And what I noticed yesterday was you had the approval of their drug for an additional indication, sleep apnea,
Right.
and it crushed Novo Nordisk. And it rallied here. This is yesterday's trading, but it closed at the low of the day. And these things stick out to me because it indicates to me that by the end of the day, people's enthusiasm for this monster of a stock and this new indication, they can't. My point being is the fundamentals are incorporated in this stock price. And if the news yesterday couldn't get the stock to act better on that, what's it going to take in the future to move this meaningfully higher? This has been a sell in my discipline for a long time. We closed below the 200-day moving average here. The 50-day goes down through the 200. The 200 is turning down. Lilly, to me, is still a technical sell.
Okay.
Interesting, actually. And that thing's been a monster. And these stocks, there's just momentum decay all over the place, Bakes. When you look in a lot of charts, are you seeing, look at that stock. That's been an absolute monster.
Yeah.
And you're starting to see it when you're either going up or you're going down. So if you're going sideways, you're just getting ready to go down often, is my opinion.
That's why I've studied this forever, because I got sick of giving back profits and not having a sell discipline. And I go back and I look at the Ciscos and the Lucents and the Nortels and all of them.
You date yourself with Lucent, my friend.
I know I'm dating myself, but that's my point, is that the song remains the same, as Robert Plant would sing. And this is what stocks look like when they roll over and start significant declines. And yes, the GLP-1 story is dramatic and I think very good for society. The stock market has already figured that out and it's saying, what are you doing for me lately? And I'm going to sell this and go to something else. And healthcare, that's just a disaster. There's David Maris and Teva, and then there's everything else. I'm exaggerating only slightly.
Oh yeah,
But
yeah.
that Teva call is a great example, right? Lilly has been the hottest stock, just a total dominator in that space. And Teva, just no one cared about value stock sitting there. And what worked? Lilly's not working, Teva's working. Like sometimes we have to go the other way of what's
Yeah.
worked for a while.
And that's why I'm thrilled to have joined you guys, because you make me think about different things in different ways. Whenever it seems like when we come up with an idea, someone's got a different angle that they bring to the table. And at the end of the day, our subscribers make money. And I say this all the time. I subscribe to a lot of services. Yes, they sound smart, but they don't make you money. And all we do is talk about what we're doing with our own investments, and it just flat out works. And it doesn't work all the time, and we'll tell you that too. But look at this, Tev. If you're a PM and you have to be in healthcare, number one, I feel sorry for you. But number two, you're going to pull Teva off the rack, so to speak, and overweight that for the first time in forever, and you're going to fade Lilly. And I just think it's inevitable.
Hey, Bakes,
Yeah.
I don't know if you had a chance to look at WGO Winnebago. I mean,
Charlie.
It's already rolled over.
I had it on over your soliloquy.
Sorry.
Your soliloquy, your Gettysburg Address. Yeah.
Let's get your brilliant thoughts then.
49.68. If it closes below that, it's really got some trouble. When stocks don't go up on earnings, then they go down. Then what's the catalyst coming? You're telling me there isn't one to get to this 334 number that's consensus when they've just lost 18 cents. That math is tough to come up with. Talk about back-end loaded. That's a joke. 22 times earnings, and this stock is under distribution. Take a look at this. When it takes out 49.68, I think you've got this in the cards right here. Is 43 is the next stopping point, and you can go much lower than that if this continues.
Hey,
So
Bakes.
Charlie, you look at Thor? You look at Thor at all? You know,
I have not looked at Thor because I've been playing Brunswick and Polaris, so I have not.
Hey, Bakes. Before we conclude,
yes,
so you don't leave us on a sour note with all your nastiness. You told me that you look at hundreds of charts and you're actually now more optimistic on nat gas.
Yeah, and frankly, I don't have I mentioned Comstock, and Bob and I have talked about that on prior shows. But this is another thing that I think our service brings to the table. Few people are crazy enough to go through every ETF that's out there every single month. And I just did this 4,000 plus, and my eyes catch things. And I alert our subscribers that natural gas is closed above the 200-day moving average for the first time in about forever. Now, it's 17 degrees in Boston, so that might be that. But look at this, okay? This has spent a lot of time under the 200-day moving average, and this is just starting to perk up for the first time in forever. Robert Marston has talked about inventory levels. Bob Morris has forgotten more about the natural gas market than I'll ever know. But I'm going to be maybe talking to Bob a little bit more often about his names as they perk up and he adds to them. We'll bring that to subscribers. But something good is going on in natural gas. And stay tuned, because we're going to be coming up with more ideas down the road. I'm almost certain of it.
Yeah, I've been trying to reposition my portfolio to add more energy to it. It's been very painful here to do that, but I think it is the right move. Antero Resources is one of the names I've added. EQT is another.
Yeah, I again, to date myself, we made a ton of money in the 90s with oil service. It's a graveyard. It is just an absolute graveyard. Marston's had a couple of great picks, niche small cap things that have worked out well. But you look at the OIH or Schlumberger or the drillers, and it's just a disaster. But let's see what goes on with natural gas. And you know, it's easy to say energy, but I think there's natural gas, and then there's oil, and then there's nuclear, and nuclear looks really good. Uranium doesn't look good yet. I'm going to stay tuned for that, because I think at some point that resumes its march upwards, because I think the fundamentals are long term very good. But natural gas, stay tuned. I think it looks way better than oil and certainly better than energy services. And I think as we do future shows, Bob and I are going to say, hey, listen, let's back up the truck on these names.
I wanted to give you an opportunity, Bakes, of at least not leaving us on a sour note, but coming back with a little bit of optimism. That's all the time we have today, guys.
There's always something good going on. Always. Yeah, always.
So come back and subscribe. Hey, you guys, I'm going to wish the three of you Merry Christmas, because I'm not going to be back on air for another week at that point.
Same to you, Paul.
You're going to be grilling me instead of the other way around. And we want to wish you all the subscribers the best of luck. Have a happy holiday season, including our executive producer, Jen Seelig, who does great work behind the scenes. But we'll see you all. Best wishes.
Merry Christmas, guys.
Merry Christmas.
Happy holidays, guys. Thanks, Paul. Thanks, Jen.
Thank you.